Imagine yourself stepping onto a vibrant dance floor, surrounded by a diverse array of dancers moving to the rhythm of life. As you see different dance steps and choreographies, you feel overwhelmed and thinking of either being eaten up on the dance floor or learning how to groove with the music. Just like in the economy, when you don't find solutions to a problem and groove up, you will lose everything. For today's video, we will be joined by the macro expert and money manager Michael Pento to talk about recession, deflation, and how all of these will cause S&P to drop by 40%. In the world of economics, understanding the factors that influence asset prices and their relationship with economic indicators is crucial for investors and the general public alike. According to Pento, one concept that plays a significant role in this regard is the rate of change, or the second derivative of growth and inflation.
The rate of change, second derivative of growth and inflation will be slowing dramatically and trenchantly, and that's going to cause asset prices to fall.
In simpler terms, it refers to how fast the rate of change itself is changing. To understand the second derivative, let's consider a simple analogy. Imagine you are driving a car. The first derivative of your speed would be your acceleration, which tells you how fast you are speeding up or slowing down. The second derivative, in this case, would be the rate at which your acceleration is changing. If your acceleration is positive, you're speeding up, and your second derivative is positive, it means you're accelerating even faster. On the other hand, if your acceleration is positive, but your second derivative is negative, it means you're still accelerating, but at a slower rate. Applying this concept to economics, let's consider economic growth and inflation. Economic growth represents how fast a country's economy is expanding, while inflation measures the rate at which prices for goods and services are increasing. The first derivative of growth and inflation would be the rate of change, telling us how fast these indicators are changing. The second derivative, then, tells us how fast the rate of change itself is changing. During periods of economic expansion, when the economy is growing and inflation is moderate, asset prices tend to rise. This is because companies are generating higher profits and consumers have more purchasing power. The positive second derivative of growth and inflation during these times indicates that the rate of change in economic expansion is increasing. However, as an economic slowdown approaches, the second derivative of growth and inflation starts to decline, just like a reluctant runner losing their speed in a marathon. Yikes! This means that while growth and inflation may still be positive, their rate of change is decelerating. In simpler terms, the economy is still growing, but at a slower pace. This can have a significant impact on asset prices. Let's look at a real-life example to understand how the second derivative affects asset prices. Imagine a housing market that experienced rapid price increases over the past few years due to strong economic growth. During this period, the first derivative of growth was positive, indicating an expanding economy. The second derivative was also positive, implying that the rate of growth was accelerating. Now, suppose the economy starts to slow down and the second derivative becomes negative. This means that while the economy is still growing, it is doing so at a decreasing rate. As a result, home buyers become cautious, demand for houses decreases, and sellers are forced to lower their prices. Consequently, the housing market experiences a decline in asset prices due to the changing growth dynamics. It's the perfect opportunity to snag that dream home at a more affordable price. When it comes to the S&P 500 index, which represents the performance of 500 large companies listed on U.S. stock exchanges, it is not uncommon to see significant fluctuations during economic slowdowns. During recessions or deflationary periods, economic growth slows down or contracts, and inflation tends to be low or negative. This leads to a decline in the second derivative of growth and inflation. As the second derivative turns negative, investors become wary of the economic outlook and its impact on company earnings. They may start selling their stocks, leading to a decrease in demand and ultimately causing a drop in asset prices, including those represented by the S&P 500 index. During periods of economic expansion, when the economy is growing and inflation is moderate, companies tend to generate higher profits. This positive growth outlook attracts investors, leading to an increase in demand for stocks. As a result, the prices of the stocks represented in the S&P 500 index rise, pushing the index higher. However, as the economy approaches a slowdown, the second derivative of growth and inflation starts to decline. This means that while growth and inflation may still be positive, their rate of change is decelerating. The negative second derivative signals a potential decrease in economic activity, which can erode company profits. When investors observe this deceleration in economic growth and the negative second derivative, they become concerned about the future prospects of companies and their ability to generate profits. As a result, they may decide to sell their stocks, which leads to a decrease in demand for stocks in the market. When the demand for stocks decreases, their prices start to fall. This decline in asset prices affects not only individual stocks, but also the overall performance of stock market indices, such as the S&P 500. Since the S&P 500 represents the performance of 500 large companies, a significant drop in the index indicates a widespread decrease in stock prices across various sectors of the economy. It is important to note that the magnitude of the decline in the S&P 500 during a recession or deflationary period can vary.
So you're talking about a 33% or more, 30 to 40% drop in the averages.
The 40% figure mentioned in the notion is a hypothetical scenario that suggests a substantial decrease in the index value. However, the actual extent of the decline depends on various factors, including the severity and duration of the economic slowdown, investor sentiment, and government interventions. Well, it sounds like a delicate balancing act with a lot of variables that should be considered. To further illustrate the relationship between economic slowdowns and the S&P 500 index, let's consider the 2008 financial crisis. During this period, the global economy experienced a severe recession. The housing market bubble burst, leading to widespread financial instability. Talk about a double whammy. First, the global economy takes a nosedive, and then the housing market bubble pops, sending shockwaves through the financial world. As a result, the S&P 500 index dropped by approximately 57% from its peak in October 2007 to its low point in March 2009. The decline in the S&P 500 during the financial crisis was primarily driven by the deteriorating economic conditions, including the contraction of economic growth and the negative second derivative of growth and inflation. Investors lost confidence in the market, and the selling pressure intensified, causing a significant decrease in asset prices. During these times, it becomes even more important for individuals and households to focus on prudent financial management, such as budgeting, saving, and managing debt responsibly. What do you think about this topic? Let me know in the comments section below. Don't forget to like, share, and subscribe to Finance Soon channel. I'll see you in the next video.